Hey guys, this is Mrs. Schoenberg. Um, we are moving on. The bottom of these notes, we have two more pages left. And this next problem we're going to do correlates to problem 12.1a. It's a dividends per share example. And so let's just get started on it. Warren Theaters owns and operates movie theaters throughout Kansas and Oklahoma. Warren Theaters has declared the following annual dividends over a 6-year period. This is all fake information, by the way. 20Y1, 80,000, 90,000, and so on and so forth. During the entire period ended December 31st of each year, the outstanding stock of the company was composed of 250,000 shares of cumulative preferred 2% stock and $20 par and 500,000 shares of common stock. So there's a couple different things going on. They have some preferred stockholders and they have some common stockholders. So the preferred stock folks are always going to get paid first. If there's money left over, the common stock folks get their dividends. So we have a chart down here that we're going to fill out, and we're going to determine the total number of dividends and the per share dividends calculation. There were no dividends in arrears at the beginning. And a dividend in arrear is if you owe the shareholder the dividend, but you don't pay it, you sort of keep a tab. And when there is a year that you can pay it, you catch up as much as you can. That's basically what that is. All right. So first off, I need to do a calculation up here. I'm going to take 250,000 and I'm going to take that times the $20 par, and then I'm going to take it times 0.02 because that's the 2%. That's how much dividends annually that the preferred shareholders should get. 100,000 annually. Okay. So the total dividends that they declared in year one is 80,000. Year two is 90,000. Just grabbing this information from above. Year three is 150,000. Year four is 150,000. Year five is 160,000. And year six is 180,000. All right, so, and I'm writing this on the preferred dividends side. So the total dividends preferred gets first, 80,000, okay? Now, over here in this little column, I'm gonna call this dividends in arrears. This is kind of a holding account, like saying, hey, we know we owed you the 100,000 annually and we only paid 80. So really, after year one, they owed the preferred 20,000. Okay. Okay, per share. How do we get this? The calculation is dividend, money on the top, divided by shares outstanding. Okay, so the calculation you're going to get is 32 cents, and that was 80,000 divided by the 250 outstanding shares. Okay. Total dividends for common, there was nothing left over to pay, and the per share then is 0. Okay, year two, 90,000. 90,000 total. Now in arrears, we have a total of 30,000. If you add the 10,000 to the previous 20, the per share calculation you're going to get is 36 cents, which is the 90,000 divided by the 250,000. Again, there's not enough, any left over for common dividends, so those two things are 0. Okay, things change in year three, and I'm really going to stop here soon because I believe that the numbers are the same in the problem on the computer, So you're going to have to take it from here, if you will. Anyway, on the 150,000, we are going to pay preferred dividends 130,000. Does anybody know why? Well, we always owe them 100,000, and we have dividends in arrears of 30,000. Like we owed them 30,000. So 100 plus 30,000 is 130,000. This time when you do your calculation, you're going to get 52 cents, and that is the 130,000 divided by the 250,000 shares outstanding. Okay. All right, common dividends. Well, hey, they had 20,000 left over, didn't they? They declared 150, got caught up those preferred shares, and now they had 20,000 left over. And this calculation is 0.04. How they got the per share on this was they took the 20,000 and the shares outstanding for common stock is 500,000. Okay, so you guys take it from there. I will tell you in year 4, this will drop back down to 100,000 because there's no dividends in arrears. All right, number 2 says, determine the average annual dividend per share for each class of stock for the 6-year period. If required, round your answers. So basically on this, there's one piece of information I need to give you. Okay, so there is this total line, and the total line here is going to be $2.40. And that was just adding up the per share. And then over here, the total is 42 cents. Okay, so that's kind of important information. So the average annual dividend for preferred, you are going to take the 240 and divide that by 6 years. Okay, let's say that answer is box. Then the average annual dividend for common, you're going to take the 42 and divide that by 6 years. And let's say that answer is heart. So whatever you get there. Then number 3 continues on here. It says, assuming a market price per share of 25 for the preferred and 17.50 for the common, determine the average annual percentage return on initial shareholders' investment based on the average annual dividend per share, letter A, for the preferred and common stock. Okay, well, here's the equation. Remember, this is a percentage. So you have to do something. But you're going to take your box answer and you're going to divide that by the $25. You got to take it times 100, and your answer is going to be in a percent. And same thing with this one. This time you'll take your heart answer, and that number you divided by the market price was $17.50. Of course, you have to take that times 100, and you'll have your answer on that one. So this should really help you with problem 1A. Okay, finally, on this page, this jumps back to homework problem 1219. And basically, it gives you all this information. Kansas Auto Racing retails products for BMWs, Porsches, Ferraris, and the following accounts and their balances appear in the ledger. We got common stock, and we got treasury stock. We got paid in capital from treasury, paid in capital common, paid in capital preferred. Here's the preferred stock, treasury stock, retail. Okay, blah, blah, blah. Also important information, 10,000 of preferred and 30,000 shares of common stock are authorized. 14,000 is held as treasury stock. And now we're going to prepare this stockholders' equity section of the balance sheet. So mind you, this is part of the balance sheet. It's just the stockholders' equity. It gets a little trickier when you have all these different stock transactions, but we're going to use the method 1. Okay, so this paid in capital, it's 1% stock, 150 par. Okay, so that amount is the 75,000. Okay. Then excess of issue price over par is the 36,000. Okay, so the first one is the actual preferred, and the second is the paid in capital in excess. We're going to add those two together, and you get 111,000. Now let's do the same thing with common stock. 36 par. It's 100,800, and then find the paid in capital in excess of par common stock. That number is 42,000. Adding those two numbers together, you get 142,800. Then from the sale of treasury stock, this is your paid in capital treasury stock number, and that number happens to be 32,000. So that's incoming money. So if you think about it, the 111,000, they sold that stock, they got the money. The common stock, they sold that stock, they got the money. The treasury stock, when they actually sold it and bought it back, they got that money. Okay, so the total paid in capital amount is 285,800. So if you add these three up, that's how I got 285,800. Okay, retained earnings is given up above. So this is where they were at, 784,000. Then if we add those two numbers together, we come up with 1,069,800. Then you have to subtract when they went and bought back those 14,000 shares. And that number is the 10,000. Okay, and that's a subtraction because they had to spend cash to go buy that. So 1,059,800. All right, that's the end of this video lecture. That should help you get through Chapter 12 homework.